Welcome class, we are group 13 and today we are excited to present you guys about Unit 13 Accountings and Financial Statements. My name is Kian and I can't wait to share my insights with all of you guys. Okay, now let me start with a single question. Who here want to be rich? Please raise your hands if you want to be rich. Okay, I can already sense the future millionaires in this room. Welcome to the Financial Freedoms Accelerators programs powered by Unit 13's Accountings and Financial Statements. Today, you are not just a typical student, you are future investors, future CEOs, and maybe even future billionaires. But here's the truth. In business, if you can't read financial statements, you basically navigating blind. So, what's the real engines behind every successful business empire? Of course, it's not luck. Of course, it's not just you have a rich uncle. It's all about accountings. Okay, so let's move to the first part, which is what is accountings? Accountings is a systematic process of recording, summarizing, and analyzing financial transactions in a company's. It involves preparing financial statements that show a company's financial performance and positions. Moreover, known as the language of business because it communicates essential financial information to stakeholders. Simple put, accounting helped you to understand about your monies. If money is the lifeblood of a company, accounting is a system that keeps it flowing. Okay, now let's discuss about the importance of accountings. First, if we answer all of the essential questions, if you are currently running a business, are you truly making a profit? Where is your cash going? And ultimately, can you still afford the ice lattes after rent and taxes? Okay, now let's move to the next part with Khánh Linh.
Good afternoon, everyone. My name is Chu Khánh Linh, and I work as a senior wealth mentor. So today, I will be discussing three key concepts: management accounting, auditing, and creative accounting. And while all these three terms relate to financial information, each serves as a distinct purpose and can strongly influence a company's performance. I will explore their definitions in depth and clarify the roles that they play. So, let me begin with management accounting. Management accounting is an internal system that gives managers the financial and non-financial information that they need to make better decisions. And unlike financial accounting, which reports the past to the outsiders, management accounting focuses on the future and on improving the performance. It isn't about meeting legal standards, but it's about guiding strategy. It turns raw data into direction, helping leaders decide which products should they prioritize, where should they cut the cost, and which actions they do that will increase the profit. Next, we have auditing. Auditing is an independent review of a company's financial statements to confirm that they are truthful, accurate, and compliant with accounting standards. To put simply, an audit gives confidence that the reported numbers can be relied on, and while it examines the past transactions, its impact is very forward-looking. To strengthen a company's credibility and to support long-term investment. Without auditing, financial reports could be really misleading, and the consequences might only surface when it's too late. So, that's why auditing is very essential for preserving trust, transparency, and stability in the financial system. So finally, let's talk about creative accounting. And this is where caution is needed. Creative accounting involves bending accounting rules to make financial statements appear more favorable than they truly are. It might still remain technically legal, but it's usually unethical, deceptive, and highly dangerous. In the short term, it may polish the numbers, but in the long term, it damages the company's most valuable assets, which is trust. So, in conclusion, we must clearly understand the differences. Managerial accounting shapes the future. It helps managers make better decisions and improve performance. Auditing protects the truth from the past. It ensures transparency and reliability. And finally, creative accounting creates an illusion, one that can destroy a company's reputation and long-term value. So, as future leaders, managers, and investors, we must rely on honest information, encourage strong internal control, and avoid unethical financial manipulation. Sustainable success comes from transparency, responsible making, and integrity. Thank you for listening. I will now invite Trân over to talk about financial statements.
Hi guys, I'm Trân, and now I will present the next part of our presentation. So now assume that I am your financial expert. First, let me ask you guys a question. Do you know how a corporation can effectively control or manage its finances? Okay, let me show you. So as a financial expert, I'd like to walk you through one of the most fundamental topics in accounting and business finance, which is financial statement. So now let's move on to the first part. What is financial statements? Financial statements are formal records of the financial activities and positions of a business. So in simple terms, they tell us how well a company is doing, how it earns money, spends money, and what it owns or owes. There are three main types of financial statements, including cash flow statement, income statement, and balance sheet. And each of these serve a different purpose, but together they give us a complete picture of a company's financial health. So now let's start with the cash flow statement. Okay, so this statement summarizes all the cash inflows and outflows over a specific period of time, and it also helps us understand where the money comes from and where it goes. Therefore, the primary purpose of the cash flow statement is to provide information about companies' liquidity and solvency. It also helps stakeholders to understand how the company generates and uses cash. And the cash flow statement is divided into three main sections. The first one is operating activities. So there are these cash flows from the company's core operation. For example, when the company sells products or pays suppliers. Next one is investing activity. So this activity includes cash flow related to buying or selling long-term assets, such as property, equipment, or investment. The last one is financing activities. So these are transactions with owners or creditors from borrowing or paying back loans, or from selling companies share. So to make this clearer, I would like to show you guys an example. So for example, a company receives $10,000 from sales, which is the cash inflows from operating activities. It also spends $4,000 on buying equipment, which is the cash outflow from investing activities. It pays $2,000 to reduce a loan, which is the outflow from the financing activity. And after all, at the end, they have 4,000 more in cash. So this is the positive cash flow. And this statement is crucial because it shows a company's liquidity, or it is the ability to generate and manage cash effectively.
All right, my name is Tùng, and let's move on to the next part, which is called the income statement and also known as the profit and loss statements. So this report summarizes a company's revenue, expenses, and the overall cost for a certain period, showing how much profit the business generated. So here is an example of an income statement. As you can see here, all the aspects are also included in this paper. So let's move on to the next one. So we can get in more detail here since these have 5 key elements. The first one is revenue. It's the total money earned from selling products. The second one is cost of goods sold, also known as COGS. It's the direct expenses involved in producing these products. And the third one is gross profit, or we can understand it as the revenue minus COGS. The fourth one is operating expenses. It's the day-to-day cost of running the company, such as wages, rent, and utilities. And move on to the last one. We have the net income. It's the remaining profit after we subtracting all the expenses. Now we have an example here. Let's just take an instance of a huge casino making $1,000 weekly. So here they spend around $400 for maintenance and all the stuff. And after you're subtracting all this money that they make, we have the total money that they actually earn is somewhere around $600. So here is the income statement helps the users understand how profitable the business is. Moving on, we have the balance sheet. So as you can see, this report shows a company's financial condition at a specific moment in time, just like a snapshot of its resources and obligations. So it outlines what the business owns, and the amount invested by the company. So a balance sheet includes 3 main things. The first one is assets, which is the items the company owns, such as cash, inventory, or equipment. The second one is liabilities, which is the amounts that company owns to others, like loans or unpaid bills. All right, so the last one that we have is the shareholders' equity. As you can see here, the owner's remaining interest after liabilities. So basically, we just subtract the assets by the liabilities, and these include some retained earnings and common stock. And let's have a look at the example here. All the assets are included here, the liabilities are here, and the shareholders' equity is also summarized in this on a sheet of paper. So let's move on to our last example. Now we have a small casino, which has something like $30,000 in assets and also $10,000 in liabilities. So just after some basic math, we can know that the owner's equity is somewhere around $20,000. So here, after paying off all the debts, the owner will still have around $20,000. So let's have a look at the conclusion. So after all this paper here, we can conclude that this financial statement helps determine the company's stability and ability to meet its obligations. Yeah, so that concludes all my session. And now I'll hand all the things over to our CEO, Thảo Nguyên.
Hi, so let's get started, shall we? So, as you just have learned about understanding money, but does it instantly make you good at it, controlling it? Well, I must say absolutely not. Why? Because we are skipping a crucial process here, which is bookkeeping. And what exactly is? Let's get started. So, what is bookkeeping? Well, bookkeeping is a process where you have to write out all the transaction day to day And when I mean all, it's all the debit and credits. Well, bookkeeping plays a crucial role in accounting. Why? Look at my company. We are a construction company started in California. So before we have bookkeeping, we used to have cash flow issue due to delayed payment and also the delay of all of it. So what we did is we outsourced our bookkeeping data. We handle it over to a professional company, which they use the data to create and forecasting cash flow money for us. Well, the cash flow improved 25%, which is a significant number. And also, I can pay all the materials and my workers really on time. So, I think our journey is going to an end. Well, before we say goodbye, we have a little secret and a gift for you guys. It's our secret handbook. Is a shortcut to learn about accounting. And scan the QR code and keep it to yourself, just for you. All right, so thank you for listening to our mini talk show, and see you next time.